Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. First of all, I would like to introduce myself. My name is Muhamad Safitri Ruswandi. I am from Accounting Department, Faculty of Economic, Universitas Negeri Jakarta. And now I want to present my final project. The title of my project is The Influence of Trading Frequency, Financial Ratio, and Market Capitalization on Syariah Stock Returns. My supervisors are Adam Zakaria and Ibu Diena Noviarini. First is background. Investment is an alternative to get a fairly effective profit. Investment can be made in various forms, both in the form of real asset investment and financial asset investment. An investment alternative that promises high returns with high risk is investing in stocks. But of course, investors need a lot of information to consider their information. Based on the 2019 BEI Trading Closing Report, the performance of the Indonesian capital market in 2019 was quite positive amid dynamic geopolitical and global economic developments. The Islamic capital market has also experienced positive developments. The growth in the number of shares, including in the list of Syariah, with a capitalization value of 3,767.93 trillion rupiah. Next is research questions. First, does the stock frequency trading affect the Syariah stock return in companies listed in the Jakarta Islamic Index? Second, does the company's financial ratios have an effect on Syariah stock returns in companies listed on Jakarta Islamic Index? And the third is, does market capitalization affect Syariah stock returns in companies listed on the Jakarta Islamic Index? Next is research purposes. First is to examine the effect of stock trading frequency on Syariah stock returns in companies listed on the Jakarta Islamic Index. Second is to examine the effect of financial ratios on Syariah stock returns in companies listed on the Jakarta Islamic Index 2016 to 2019. And the third is to examine the effect of market capitalization on Syariah stock returns in companies listed on Jakarta Islamic Index 2016 to 2019. And next is the benefits of this research. First is the theoretical benefits. This research is expected to support the signaling theory and the efficient market hypothesis theory. Signal theory plays a role in signaling information about the company's financial ratios and other information that can reflect stock returns that investors will get, while the efficient market hypothesis theory becomes the basis for consideration for investors because new information provided by the government or issuer companies can be widely obtained by investors and can be affect the stock returns that will be received. This research is also expected to provide benefits as empirical evidence related to stock trading frequency, financial ratios, and market capitalization on Islamic stock returns. Then it becomes additional literature for the basis or reference for research related to the next Islamic stock returns and minimizes the research gap that occurred in previous research. The second is practical benefits. One is for the companies. This research is expected to be input for company management in providing information related to company performance and determining company policies that can affect company stock returns. Second is for investors. This research is expected to be used as useful information for consideration before deciding to invest in a company. Next is literature review. One is signaling theory. Signal theory is an action taken by a manager by providing direction to investors on how company managers can see the obstacles that will be faced by the company in the future. Signal theory explains why companies have the ability to voluntarily report information to the capital market, even though they are not mandated by regulatory agencies. Information reporting by management aims to keep investors interested in the companies concerned. Signal theory states that if there is good communication, it will lead to good performance. In the theory, it explains that good financial statements are a signal or sign that the company is operating well, and giving a good signal will be responded well by other parties. The next is efficient market hypothesis theory. A broad understanding of the efficient capital market is a situation where there is a new information both from the government or of a country and the company or issuer concerned, that the information will be spread widely, quickly, and easily, and can be obtained cheaply by market participants or investors. An efficient market is a market condition where stock prices describe the actual state of the company, while an efficient market is a market condition where the price of securities is significantly influenced by investor behavior so that the stock price does not reflect the actual state of the company. And these are the three groups of efficient market forms. First is strong form market efficiency. Second is semi-strong market efficiency. And the third is weak form market efficiency. Next is stock returns. Stock returns is the expectation of investors from the funds invested through stocks, where the result of the investment are in the form of yields and capital gains or losses. The stock return itself can be divided into two, namely the realized stock return and the expected stock return. Realized stock returns is the rate of return that has occurred and can be calculated by using historical data. Meanwhile, the expected returns is the stock return that has not yet occurred, but is expected to occur in the future. Stock returns are measured using the stock return formula as follows. And this is the formula of stock returns. Next is stock trading frequency. Stock trading frequency is the number of stock trading transactions in a certain period. The frequency of stock trading describes the state of how many shares of a company are traded in a certain period of time. A higher the trading frequency of a stock, the more actively the stock is traded. The frequency of stock is trading greatly affects the number of shares outstanding. If the number of shares trading frequency is large, the shares are declared as shares most actively traded and indirectly affect the volume stock trading and also the stock price during the period. Next is financial ratio. The financial ratios are ratios that can see the financial condition of an entity in a certain period. Ratio analysis is a form of method commonly used by company shareholders to be able to see and assess the performance of financial condition of the company, especially in terms of making an investment decision. First is earning per share or EPS, which is the X2 of my research. EPS is the ratio used to see the level of profit earned for each share owned by investors, and this is the formula of EPS. The second financial ratio is return on equity, which is a ratio used to see and measure the level of effectiveness of the company in generating profit by utilizing its shareholders' equity. The formula of ROE is net income per equity. The third financial ratio is debt to equity ratio, which is a ratio used to see the level of use of debt to the total shareholders' equity owned by the company. The formula is total debt per total equity. And next is the market capitalizations. Market capitalizations is a value that shows the measurement result of the company based on the value of shares outstanding at a certain time period. In general, stocks with a large capitalization values are the target for investors to make a long-term investment. Because stocks with a large market capitalization have a positive potential in terms of company growth, in addition to dividend contribution and relatively low risk exposure. Because of many investors are interested, the stock price will generally increase along with high investor interest. This will provide a relatively high return as well. And this is the previous research of my research about stock returns. This is the 20 previous research. Next is hypothesis. The first hypothesis is trading frequency has a positive effect on Islamic stock returns. The second is earning per share has a positive effect on Islamic stock returns. The third hypothesis is return on equity has a positive effect on Islamic stock returns. The fourth is debt to equity ratio has a negative effect on Islamic stock returns. And the final is the fifth hypothesis is market capitalization has a positive effect on Islamic stock returns. And this is the research method that I used. The first is a unit of analysis. The unit of analysis in this study is a company listed on the Jakarta Islamic Index during the 2016 to 2019 period. The population in the study used were companies listed in Jakarta Islamic Index 2016 to 2019, amounting to 30 companies. And the sample of my research is 25 companies listed on Jakarta Islamic Index in 2016 to 2019 and were selected based on the purposive sampling method. And this is the variable operationalization. Here is the stock returns, trading frequency, earning per share, return on equity, debt to equity ratio, and market capitalization. And this is the analysis technique. I used 4 analysis technique, which is descriptive statistical analysis, panel data regression analysis, classic assumption test, and hypothesis testing. And how about the result? A descriptive statistical analysis. A descriptive statistical analysis can provide information about the description of a data. This study uses descriptive statistical analysis, which includes the range or mean, maximum, minimum, and standard deviation values. The result of descriptive statistical analysis are presented in the table. For stock returns, the mean value is of 14.4. The maximum value is 1026.9. The minimum is minus 48, and the standard deviation value is 111. The trading frequency means is 281,733.5. And the maximum value of trading frequency is 2,111,116.0. And this is the descriptive statistical analysis of my research. Next is the stock return. The minimum value of stock returns is minus 48, which is from Lipo Karawaci, and the maximum value is 1026.9, which is the Barito Pacific 2016. The mean value is 14.4. The standard deviation is 111. The data is heterogeneous because the data is heterogeneous because the distribution of the data varies. Wide sample diversity. And this is the trading frequency, which the data also the data distribution or data points close to the average value, and narrow sample diversity. And this is the earning per share, as the data is heterogeneous because the distribution of the data varies, and this is wide sample diversity. And this is the return on equity, which is the data is heterogeneous because the distribution of the data varies. And this is wide sample diversity. And this is the debt to equity ratio, which good data distribution or data points close to the average value. And this is a narrow sample diversity. And this is the market capitalization, which the data is heterogeneous because the distribution of the data varies, and this is wide sample diversity. And next is selection of panel data regression analysis model. The first is Chow test. The Chow test is a test to choose the best model between the common effect model and the fixed effect model. The result of the Chow test are shown in the table below. And based on the test result in the table above, it can be seen that the probability value or P statistic in the chi-square cross-section is 0.2601, which is a greater than 0.05, which means that the hypothesis 0 is accepted. Thus, the model chosen is the common effect model. And after that, we have to test the Lagrange multiplier test. The Lagrange multiplier test is a panel data test to compare random effects or common effect model. The result of the Lagrange multiplier test are shown in the following table. Based on the result of the Lagrange multiplier test, in addition, it can be seen that the cross-section value in Brose-Pagan is 0.1296. Here, that is greater than 0.05, so that the Lagrange multiplier test accepts the hypothesis 0, which means that the best method chosen in the study is the common effect model. And after that, I have classic assumption tests. First is normality test. The normality test aims to test whether the residual variables in the regression are normally distributed or not. The following are the result of the normality test in this study. From the result of the normality test above, it can be seen that the probability value is 0.278824 or 27.8%, which means that it exceeds the significance level of 0.05 or 5%. This shows that the residual data in this regression is normally distributed. Next, from classic assumption test is multicollinearity test. Multicollinearity test is a test carried out to determine whether in a regression model there is intercorrelation or collinearity between independent variables. Intercorrelation is a linear relationship or a strong relationship between one independent variable and another independent variable in a regression model. And from the result of the multicollinearity test indicate that there is no relationship between the independent variables because the result of the center VIF value is less than 10. Thus, the data in this study does not have a multicollinearity problem. Next is heteroskedasticity test. To test the variance in equality in the residual from one observation to another observation, a heteroskedasticity test is needed. This study uses the Glasser test to detect heteroskedasticity test. If the p-statistic value of ops r squared is more than 0.05, then there is no heteroscedasticity problem. In addition, if the p-statistic value of each variable is above the 0.05 level of significance, then there is no heteroscedasticity problem. From the result of the Glaser test presented in the table beside, it can be concluded that there is no heteroscedasticity problem because the p-statistic value of ups are squared and the p-statistic value of each variable are above 0.05. Next, from classic assumption test is autocorrelation test. The autocorrelation test was carried out with the aim of testing a linear regression model for the correlation between confounding errors in the T1 period. The autocorrelation test in the study used the Durbin-Watson test, namely by comparing the Durbin-Watson value calculated with the Durbin-Watson value dl and du in the table. Based on the result of the analysis, the regression model does not have autocorrelation problems because the DW test obtained is 2.096158, which is at du is 1.7671 and 4 means du is 2.2329, which means that the data in this study does not have autocorrelation problems. Next, from classic assumption test is panel data regression analysis. After selecting the common effect model, the following is the panel data regression equation. Stock returns, which is minus 120.1374 minus 8.934520 FP minus 0.019017 EPS minus 0.044330 or ROE plus 2.801906 DER plus 13.6681 KP, which is the description for FP is trading frequency, EPS is earning per share, ROE is return on equity, DER is debt to equity ratio, and KP is market capitalization. Next is the hypothesis testing, which is the first is t-test. The purpose of the statistical t-test is to find out how far one independent variable has an effect on the dependent variable by assuming the other variables are constant. In this test, a significant value of 0.05 or 5% was used. In the probability less than 0.05, it means that the independent variable has an effect on the dependent variable. And this is the t-test results. H1 is the result shows that the trading frequency variable has a significant probability value of 0.1782, which is greater than 0.05 or 5%, which means that there is no significant relationship between trading frequency and Syariah stock returns. This shows that the results of the H1 test are not accepted. Second is the result shows that the earning per share variable has a significant probability value of 0.2134, which is greater than 0.05 or 5%, which means that there is no significant effect resulting from the relationship between EPS and stock returns. This shows that the result of the H2 test are not accepted. The third is the result shows that the return on equity variable has a significant probability value of 0.6923, which is greater than 0.05 or 5%, which means that there is no significant relationship between return on equity and stock returns. This shows that the result of H3 test are not accepted. Fourth is the result shows that the debt to equity ratio variable has a significant probability value of 0.4110, which is greater than 0.05 or 5%, which means that this is no significant relationship between the debt to equity ratio value and stock returns. This shows that the result of the H4 test are not accepted. Fifth is the results show that the market capitalization variable has a significant probability value of 0.000, which is smaller than 0.05 or 5%, which means that there is a significant relationship between market capitalization and company stock returns. This shows that the result of the H5 test are accepted. And next is the F test. The regression model can be said to be feasible if the result of the probability is less than 0.05. The thing to note in this test is the probability value of the F statistic contained in the table, which is 0.000154. Meanwhile, the F table value obtained is 2.3709765 from 60 observation with 5 independent variables and 1 dependent variable with a significance level of 0.05. So it can be seen that the probability value of the F statistic is less than 0.05. This result indicate that the regression model on the panel data is suitable for use in this research. And next, from hypothesis testing is coefficients of determination test. The purpose of the coefficient of determination test is to see how much the model's ability to explain the variation of the dependent variables is. As stated in the table beside, the adjusted R square value is 0.301285, which is this value indicates that the independent variables, trading frequency, earning per shares, return on equity, and debt to equity ratio, and also market capitalization are able to explain stock returns of 30.12%. And next is the discussion. First is the effect of trading frequency on Sharia stock returns. The result on the hypothesis testing that have been carried out show that the frequency of stock trading has no effect on Islamic stock returns. The result of the study explains that the value of the frequency of trading shares of a company has no impact on the increase and decrease in stock returns in the company. This is because the stock returns do not change based on the frequency of stock trading, but there is a still bigger influences, such as the economic condition that are still under pressure due to the crisis, causing Indonesia's economic growth to slow down in 2009. Withdrawal of capital and increasing investment risk caused stock prices to fall. This can have a negative impact on stock trading in the capital market and of course have an impact on the decline of the value of stock returns. The results of this study are in line with research conducted by Yusra in 2019, which examined the frequency of stock trading on Sharia on stock returns in cosmetic and household companies on the Indonesia Stock Exchange. Next is the effect of earning per share on Sharia stock return. The result of hypothesis testing that have been carried out show that earning per share has no effect on Islamic stock returns. So it can be said that the EPS value of a company will not an impact on the increase or decrease in the value of stock returns. This shows that companies that get higher EPS do not consistently have large stock returns because the company's ability to use its assets is less effective, resulting in very low profits. This means that the company's stock return is more influenced by other factors besides EPS. The result of this study support the result of previous research conducted by Rahmawati 2017, which examined the effect of earning per share on stock returns in food and beverage companies listed on Indonesia Stock Exchange of the period 2011 to 2015. Next is the effect of return on equity on Sharia stock return. From the hypothesis testing that has been done, it can be found that return on equity has no effect on Sharia stock returns. This indicates that the company cannot guarantee its equity with profit. Small companies have an ROE value that tends to increase rapidly in line with the increase in net income or earnings. This can also be due to the company's ability to create profits generated from capital is still lacking because the available capital is still greater than the profit generated. With a high amount of equity resulting in a lot of funds that are less productive, it is necessary to allocate funds that can generate profits. Investor will respond to this by assuming that the company is not good at managing its funds and indicates the investor's decision in determining the investment decision to purchase these shares. The result obtained from this study support the research conducted by Rahmawati 2017 and Tumongor 2017. Next is the effect of debt-to-equity ratio on Sharia stock returns. Based on the hypothesis testing conducted, it was found that the value of the debt-to-equity ratio had no effect on stock tradings. Some investors think that the higher of DER reflect that high level of corporate debt, thereby increasing the risk that investors accept as a result of the debt interest expense borne by the company. Seeing this causes investors to tend not to invest in the company so that there is a decline in stock prices, which in turn will have an impact on the decline in the company's stock returns. Another reason is that the higher the DER value reflects the company's relatively high risk. As a result, investors tend to avoid stocks that have a high DER value. The results in this study are in line with research conducted by Indah Puspita Dewi and Rahyuda 2016. Next is the effect of market capitalization on Sharia stock return. Based on the hypothesis testing conducted in this study, it was found that market capitalization has a positive effect on Sharia stock returns. It means that a greater trading frequency will increase the company's stock returns. It can also happen because the market capitalization value contained in the stock indicates that these shares are the leading stocks in the capital market. Stocks with the large capitalization values are generally the target of investor to long-term investment because of the company's growth potential. Due to the large number of enthusiasts, the stock price will increase so that it can result in an increase in the value of the company's stock return. The results in this study are in line with research conducted by M.Si 2021, which examines the effect of market capitalization on Sharia stock returns in the tourism sector listed on the IDX. Next is closing. This is the conclusion. The study was conducted to identify and provide empirical evidence regarding the effect of trading frequency, financial ratio, and market capitalization on Islamic stock returns. There are 25 companies that meet the sample criteria with a study period of 4 years in determining of final samples. Researchers carried out transformation and outlier on a sample used to overcome the problem of normality in data testing, so that the total observations studied were 60 observations during the 2019 to 2009 during the 2016 to 2019 period, which the panel data aggregation analysis method using the EFUSE 12 application program. First is trading frequency has no effect on Sharia stock returns. Second, earning per share has no effect on Syariah stock returns. Third is return on equity has no effect on Syariah stock returns. Fourth, debt to equity ratio has no effect on Syariah stock returns. And fifth, market capitalization has a positive effect on Islamic stock returns. And this is the implication for companies. This research can be used as a reference in making decisions, especially company management. The decision can be in the form of taking policies to maintain the stability of the company's stock returns. And for investors, investors can consider factors that can affect stock returns, such as company's market capitalization, so they can consider the decision to invest in companies that have a large capitalization rate. It is important for investors to be able to consider the risk and return that will be obtained. Next is research limitation. 1. The study only takes samples from companies listed on Jakarta Islamic Index on the Indonesia Stock Exchange for the 2016 to 2019 period, so that researchers do not know the condition of the variables tested on companies outside the Jakarta Islamic Index. Second, this study only tested the variables of trading frequency, earning per share, return on equity, debt to equity ratio, and market capitalization in the 2016 to 2019 period, so that other variables outside of this variable have no applications in the study, and conditions in other periods outside the study could be different. 3. In the study, the proxies for financial ratio used are only earning per share, return on equity, and debt to equity ratio, while there are other proxies that can be used beside these proxies. And this is the recommendation for further research. First is further research, and the first is further research can add samples of other Islamic companies that are outside the Jakarta Islamic Index on Indonesia Stock Exchange. Second, for the further research can also add other variables such as trading volume, stock price, trading day, book value per share, price to earning ratio, and other company fundamental factors. In addition, further research can also add macroeconomic factors such as inflation and the rupiah exchange rate that can have an influence on stock returns. Third, for the further research can also use different research method and can add more research periods in order to get better and more accurate research. Thank you for the attention. Wassalamualaikum warahmatullahi wabarakatuh.